Welcome to Capitalize Your Finances, the podcast that's your ultimate guide to mastering personal finances and unlocking the secrets of entrepreneurship. Each week, we dive into the world of personal finance and business development and have fascinating conversations with industry experts, seasoned entrepreneurs, and thought leaders who share their insights, strategies, and stories to help you get ahead in life. Whether you're a seasoned entrepreneur looking to scale your business or someone just starting out on your financial path, this podcast is your go-to resource for inspiration and actionable insights.
Welcome back to Capitalize Your Finances. As always, I'm your host, Christopher A. Panayiotou, certified financial planning professional, the Cap in Capitalize. And on today's episode, which I've been working on for many months, I'm going to get into what I learned from reading all of Warren Buffett's annual shareholder letters through his holding company, Berkshire Hathaway. But before we get into the meat of this incredible episode, and this took me hours, days, weeks, months to complete, the free advice for the week. And it's actually one of my favorite Bible verses, Romans 2:12. Do not conform to the pattern of this world, but be transformed by the renewing of your mind. That Bible verse is actually quite telling into what we're going to be talking about today, because in order to get to any level of success, you cannot do what everyone is doing. And Warren by no means did, or continues to do, because he's still doing it, which is beyond insane. He's still doing it to this day, his way, which is now becoming a more popular way, which we'll get into during this episode. And so how I want to knock out this episode is I want to break down the outline to you, and because there's a lot we're going to go over today. The first thing we're going to talk about is personally how I came upon completing this extremely large feat. And then what we're going to do is we're going to talk about what my initial goal was going into this. I'm then going to go over, thirdly, what I actually got out of this practice. And I call it a practice because this is a mammoth. And then I'm going to close the episode out with the greatest takeaways, I gained from doing this and what you should take away from this as well. So the first thing I'm going to talk about is how I came upon completing this extremely large feat. So the first place that I want to start is actually my upbringing. So I grew up in a business-oriented household, and Buffett was mentioned in the background. I don't have any relationship with my father anymore, but he was unhealthily obsessed with Warren Buffett. And so I heard of the name, but when you're little and people are just throwing names or terms around, you don't really know what that means. And as time went on, naturally, I took an interest to the world of investing and wealth management. And so when I started in the industry, it was pretty much impossible to not know who Warren Buffett was. Even if you're not in the world of money today, it's pretty much impossible to not know who he is. And his voice and his brand obviously was growing and compounding, I guess pun not intended, as the years went on. And I became more curious into what his deal was. Obviously, I knew he was a successful investor, but I didn't really know the ins and outs of Buffett. And more importantly, when you get to that level of success, whether it's wealth management or creating a business of some other proportion, I wanted to know what made him tick. And unfortunately, when I started in the industry, and you guys get this if you've started any business, I didn't have the time, and I couldn't afford to really do anything outside of building my business because I had no money. But the whole idea of investing and investigating Warren Buffett, that went out the window for many, many years. And again, he was always in the background, and he was growing and growing and growing. And as Berkshire is compounded into the behemoth that it is today, like I've said already, it's impossible not to know who he is or who he was back then. But I also will say, once I discovered what I call true financial planning, what I discovered what that was, the whole idea of investing took a back burner, and it did for years. But one thing I want you all to know that are listening in, that are not in the world of podcasting. I mean, for those of you that are in the world of podcasting, you know this, but one thing that people don't think about when it comes to podcasting is that you can use podcasting not only as a platform to teach others, you can use it to teach yourself. And in my case, I have been incredibly fortunate to interview some of the brightest minds in the investment world. And there's a number of them out there, but a couple of them that I will name are Robert Hagstrom, Guy Spear, Gautam Baid, Kyle Grieve, William Green. Now, William Green is a financial journalist. He does not invest people's money directly. Kyle Grieve is a podcast host. And again, all of these guys have been on our show in the past. And Kyle invests his own money, but the Investors Podcast Network, he talks about it a lot. What do all these guys have in common? They all have read every Berkshire Hathaway shareholder letter written by Warren Buffett. And because of that, when I started to look at what all the most successful investors in our industry have done, it all's led back to going through this process. Now, I've been extremely blessed with the business that I have today. And I say that because unlike early on in my career, I have been able to afford to take the time to reinvest into furthering skills in various degrees of my industry, because I'm forever a student. And in particular, all of these guys not only have told me to do what I'm doing as far as the shareholder letter readings, but they've also given me bits and pieces that in some cases have materially changed my life. For those of you that have been listening in for a while, you have heard that I have a thinking room in my headquarters, and Robert Hagstrom was instrumental in giving me that idea, in having me build that out. And it's interesting because when I decided to start this journey of reading every shareholder letter, I started and finished in that same room in which Robert inspired me to build. So Robert, thank you for that. Now, the reason I wanted to do this was to really surface level sharpen my investment mind, as there is a humongous difference between planning and investing. Huge difference between the two. Buffett is by no means a financial planner, and I'm probably going to get some slack for that, but he's not. But it is nearly impossible to argue against his investment acumen. So for me, it was a no-brainer to follow in the footsteps of some of the greatest investment minds that I know and do this task. Now, my initial goal, like I said, it was to better understand investing and how to make an investment. Now, I obviously know how, as far as like operationally, and I'm talking like I'm going into this just with absolutely no knowledge of this. I'd like to think I have more knowledge than the average person just by what I do. But like I said, I'm not on the investment side of things. I'm on the planning side of things. And I wanted to sharpen my investment mind that much more. And for me, surface level thinking, if Warren Buffett had been able to compound Berkshire Hathaway, and this is just very fact of the matter, he's been able to compound Berkshire Hathaway since he took it over in 1965, so a bajillion years ago, at around 19%. That's almost double the S&P 500's return over that period of time. And not only did he compound, he wrote in these writings how he did it. So for me, if I went through this practice, how could I not get anything from this? Like it's impossible not to gain value. And it was interesting because after reading the first few years of Warren's letters, I was gaining information, but admittedly, it wasn't anything earth-shattering. And initially, I have to be brutally honest here, I was flying through these annual letters because the first couple years, his letters were only a couple pages long, and I'd say decently surface level relative to what they became. And so, for me, as far as the black and white knowledge of investing, I kind of knew a lot of what he was saying, but it wasn't until around 1970 where things took a mighty turn for the better, which we will get into right after this commercial break. So don't go anywhere. Stick around.
Are you ready to transform the way you approach sales? This episode is sponsored by the second book in the Capitalize series, Capitalize Your Sales, the all-in-one sales framework that saves you from ever struggling again and teaches you how to sell with sincerity, which dives deep into the art and science of driving sustainable growth. Packed with strategies that go beyond surface-level techniques, this book will help you understand what it takes to truly connect with clients, build long-term relationships, and close deals. Whether you're looking to fine-tune your sales craft or break through to the next level, Capitalize Your Sales offers a roadmap to success designed for today's fast-paced business world. Head on over to your favorite bookstore, order today, and start capitalizing your sales immediately. And now, back to the episode.
Welcome back from the commercial break. And the third piece of this episode is what I actually got out of reading every Berkshire Hathaway annual shareholder letter. And as I stated before the commercial break, up until 1970, Buffett's shareholder letters were by no means long. And for me, they weren't profound or anything groundbreaking in terms of my new understanding. And I thought about that from 1965, when Buffett first started writing these, through 1970. He was ironing out the kinks and in learning how to write these letters in the way that we all know today. And you got to think about this. Anytime you start out with something, it's going to take you a while in reps to get going. And if Buffett only had one crack a year of doing this, I showed two fingers. I don't know why I did that. If he only had one crack per year, it's not a shocker to me that it took him half of a decade or so to get in his groove. Now, once 1970 hit, this is where it got very interesting for me. So during the 70s and the 80s, what I gained, and again, this is for me, it was infinitely more important than just investment advice. If you want to have the best masterclass on business and ethics in running a business you will ever read, start from 1980 and read through 1990, the Berkshire Hathaway shareholder letters. And so what I wanted to do is take some of my hand-picked notes. And for those of you that are just listening in, you can't see it, but if you're watching on Spotify or YouTube, I actually brought my stack of Berkshire Hathaway letters as well as the copious notes that I took. And it's funny, before this recording, my brother was saying like, dude, you read all of these? Like, yeah. He's like, dude, I would blow my eyes out if I had to read all that. I'm like, well, there were times where it got really, really thick. Because after about 1970, it went from 3 to 4 pages long to some cases, one year was 30 pages long. And these are not light reads. I mean, you've got to really, really, really commit to it. So I wanted to bring in some of my hand-picked notes and read through some of them, as these are what I drew from the direct text. And I get it. Some podcasters, they like to abbreviate some of their learnings and summarize it. But this stuff is so good. I want you to hear it directly from the source. And one thing I want you to know is I'm not going to reference direct years, because when I went through this practice, I actually didn't write what year this was from. I started to initially, but then I realized if it's valuable to me, it doesn't matter what year it came from. All it matters is it's valuable. And also selfishly, it takes the fun out of it for you if you're trying to read through all of this. So you got to go through the practice like I did. Now, with that being said, I'm just going to start opening my notes and start to read. And again, just like when I started, I don't know exactly where this is going to take us, but I have a feeling you're all going to enjoy. And so early in his in terms of career of owning Berkshire Hathaway, he was referring to a lot more of investment terms and in business terminology, but then it got into more of the ethics side of things, like I stated earlier. So let's see, what would be some of it? Okay. This was one thing that I found really striking about Warren, for those of you that did not know. So in 1978 on the textile business, even though Buffett knew, consciously or subconsciously, that the business that he bought, which was Berkshire Hathaway, a textile business, even though he knew it was inferior, due to the commitment to the people, he balanced taking profits to invest elsewhere while also making sure that his business stayed viable due to the importance within the community. Sometimes it's okay not to necessarily gauge directly returns. And it wasn't a horrendous business, just to be clear, but there's a ton to take away from this. And I'm not going to go too deep into this other than if you're in this weird conundrum where, let's say that you're working with a business, you've bought it out and it's not as profitable as you thought. Or let's say that you're working with friends or family. And, I'm fortunate not to have this issue because my brother's an absolute rock star at what he does. But let's say that you do have a family member, and I've seen this with family businesses in the past where maybe the family members aren't as good as, frankly, they should be, or if you hired someone else, but there's a balancing act there. I think the merit in ethics of balancing business with the benefit of a profit, it's something highly overlooked today. Now, one thing that I noticed, which was very, very interesting, was Warren always threw in little nuggets. So you'd be reading, and then there'd be like a quick sentence, and it was almost like he slipped it in there, hoping that people would catch on to how valuable it was. And one quote that struck me was, "You do not adequately protect yourself by being half awake while others are sleeping." And it's this whole concept of, this was written decades before passive investing or index investing really became a thing. And now it's everywhere. It is full blown. As we're recording this in late 2025, if you Google index fund, there are going to be an infinite amount of articles, terms, videos, you name it. Passive investing is very, very, very popular. And being passive and automating with your money is very popular. Warren knew early on you cannot fall asleep at the wheel when it comes to your money. And just these little nuggets, it gets you to understand how truly valuable automation. Let me rephrase that. Automation can be a detriment to your finances if you're not careful. And I can tell you, this guy does not automate anything. He outsources a lot, but he doesn't automate everything. Okay. Now, one thing that I've noticed is a lot of people believe that bigger is better in terms of business and growing and growing and growing. One of his quotes struck me in a massive way. "A compact organization lets us spend our time managing the business rather than managing each other." So for those of you that do run a business and you're trying to grow or expand or you're thinking about it, sometimes less is more. And sometimes less is more, both figuratively as well as literally, because you can earn more profit per person, the camaraderie is better, things of that nature. These are the secrets to businesses' success. It was interesting. We apply ourselves with enthusiasm and energy. We define ourselves with extreme precision, our areas of competence, and we act decisively on all matters within them and don't sway from them. The third, we ignore even the most tempting propositions falling outside of those competencies. And number four, we behave with obsessive commitment towards a high-grade manner with everyone we deal with. So this whole idea of trying to diversify outside of what you know, Buffett was and still is the king of staying within what he calls your circle of competence. And that whole concept is you invest in what you know, you understand, it'll be there for a while, et cetera, et cetera. But what he talks about a lot in the 70s is applying that concept to everyday business. So if you run a business or you work within a family-owned business, or even if it's not a family-owned business, if you work for a big business and you feel as though things are getting too out of hand, they're getting too big, they're getting too abstract, sometimes it's okay to slim it down. And if you're at a place where that's just not possible, it's okay to look for something else where you can slim it down. And maybe that means you're getting a pay reduction, but you'll probably be better off for it. And that struck me as fascinating. There's a concept in investing called arbitrage. And arbitrage is where you basically, you know what a price is going to be because they've announced it. You go and buy it, and you're buying it on the hopes that it goes to whatever that price may be. So I can speak about this in the past because it's no longer prevalent because it's gone. But a couple of years ago, my team and I, we were actually analyzing a company, Activision Blizzard. And Activision Blizzard, it was announced that it was going to be acquired by Microsoft at $95 a share. And at the time, it was, when we first started looking at it, like $70 a share. And of course, did risks, returns, whatever the case is. We decided to buy it. Clients earned money, nice rate of return, moved on. Arbitrage, though, it's extremely risky. And so one of the things that struck me with Warren was how he used arbitrage investing. And arbitrage was used when Buffett had more money than ideas, and it was only for the mergers or the sales of companies. And so let's say that you have a portfolio and you need X amount in cash, and then you want to allocate ideally X amount per company within the portfolio. And let's say you have too much cash, but every other company that you own, maybe it's too pricey, but you don't want to sell it. You don't necessarily want to buy anymore. And so arbitrage was this weird time where he would allocate money where you don't have anywhere else to go, but you don't want to have it in cash. So you can, quote unquote, risk that money in an arbitrage asset, because arbitraging can be very, very risky. There's a ton of risk. There's political risk. There's regulation risk because a lot of these regulators may not approve of it. The Activision Blizzard one I just mentioned, it almost didn't go through. And if that was the case, investors wouldn't have gotten that. Now, I could have made the argument that if the company that bought them, which was Microsoft, valued the company at $95 a share, it'd be safe to say that it's probably worth $95 a share. So you could, in theory, own it till it gets to that rate and then decide to sell it or whatever the case may be. But then if it doesn't go through, the public may look at that and go, oh, it didn't go through because it's a bad company. And then the whole thesis is lost. But arbitrage is something that can be very, very valuable, but I think people overuse it. And so if you're going to utilize arbitrage, use it cautiously. A lot of people look at buying and selling equally in investing. And one note that Warren put out, and I believe this was in the 80s, was the idea of devoting a lot of time to attractive buys, not the possibility of attractive sells. So this whole concept is very valuable, because when you're investing your money, or if you're watching and you do this professionally and you're investing someone else's money, it's much more important to figure out when to buy than when to sell. The when to sell concept, that's going to happen naturally, because when you've done all of the analysis and the price goes from where it is today to where you eventually think it will be, and that eventual becomes that moment, then you do the diligence again, you decide to sell. But as long as you get the buy side right, the rest of it takes care of itself. And I'm saying this because a lot of people have asked me, when do I go and sell a company? And yes, there's metrics and things that I think of and my teams think of when it comes to selling a company. But you really want to focus on the buy side of things. And Charlie Munger, Warren Buffett's business partner, was quoted to always emphasize the study of the mistakes as opposed to the successes. Warren learned a boatload from Charlie, and he started applying a lot of it. He always applied a lot from Charlie Munger, his longtime business partner. But you started to see him shifting his mindset in the mid-'80s, because Munger had this whole concept of buying quality businesses at fair prices. And as long as you buy quality, the rest of it will take care of itself. And Warren skinned his teeth on what we call the cigar butt businesses, where, you know, if you had a cigar butt on the ground, you had one puff left, you puff it, you throw it away, you do another. And it was this whole metaphor of buying companies that were super, super cheap. And then if they came back to the value of what people thought were appropriate, you've made a lot of money, like a deep, deep discount. And you can only do that for so long. And occasionally, though, you do the analysis on these quality businesses and you're going to make mistakes. Munger's whole concept to Buffett was really hone in on those mistakes, because that's where you're going to learn the most from it. And also make sure that your mistakes are not too great where they completely deteriorate everything that you've grown. It was around the 80s where the generally accepted accounting principles really started to tighten up. And I'm saying this because up until this point, when it came to investing, yes, you're always taking reports at their word because you have to. And you would assume that the accounting firm that did the audit did it correctly. The SEC obviously put their hand of approval, not on buying a company or not. They're just approving that, yes, this is legitimate. We've looked this over, auditing, etc. But there started to become this whole idea of not necessarily cooking the books, but making the books look better than they actually are, which I know sounds similar, but it's not. So here's an example. One thing that a lot of people looked at in the 70s and 80s was the company just growing at a rapid rate, growing revenues. Yes, that's very valuable. But what Warren asked was how much additional capital was required to produce those additional earnings. And so to translate that, a lot of these companies were growing at record revenue rates, but they were putting in more money at a faster rate than what the revenue was growing to. And I think that's a really good thing for you to take away at home if you are investing on your own, because a lot of these companies out there, not all of them, there's a lot of value to be had out there. There always is, always will be. But there are a lot of companies out there, they're growing at these rapid rates. But are they doing so in a prudent way? And only time will tell. But again, history doesn't repeat itself, it rhymes. So a lot of people, when it comes to getting wealthy, they think that they can do so quickly. Also, as we are recording this, unfortunately, things are more expensive. Times are tough. I get that. And so when times become more difficult, people try to hit these Hail Marys when it comes to investing because they'll just get rich quick. Or in some cases, just get out of their difficult situation that much faster. And that is by no means how you're going to be successful in the world of money. Warren's quote, "Time is the friend of the wonderful business, the enemy of the mediocre." You could translate that into your money habits. Time is the friend of the prudent planner and the enemy of the mediocre. It's the same thing. Do not try to do anything money-wise fast because it's not going to end well. It's just not. Speaking of that, all things being equal, if you have a quality business versus a quality person, the business is always going to win. Meaning, if you had someone that was running the business and it was an amazing business, but it was run by an absolute moron, that business, it may not do as well for the period of time when it's run by an idiot, but it's going to do just fine. But if you're in a business that is not good, it doesn't matter if you have the best CEO in the world, you are going to get hurt. So for those of you to translate that into everyday life, if you're working somewhere and let's say that you're working for a business and you see the writing on the wall. I don't know what the equivalent would be, but like back in the day, if you worked at Blockbuster, RIP, loved Blockbuster. But if you worked at a Blockbuster and you saw Netflix just coming to basically take your lunch and kill you, it doesn't matter who the CEO was. It doesn't matter who your manager was if they were phenomenal. You knew you were going to get hurt. You knew it. And so if you're in a situation where you notice that the writing's on the wall, you may want to look. Also on the flip side, let's say you work at a really big company, and let's just say that the owner or the CEO or manager or whatever, they're just not great. You can take, I don't want to say pride, but you can take positive note that that person's not going to be there forever. And if you do love what you do, but you don't like that person, generally speaking with the great businesses, the bad people are going to see themselves out. That's another amazing takeaway that I took indirectly from this. In terms of owning a company, virtually all people in the world of investing have like their own timeline. And with Buffett, his timeline, he had a couple ways of saying it. If you aren't willing to own a stock for 10 years, don't think about owning it for 10 minutes. I think that's incredibly valuable because think about how many people are trying to buy in and out of companies on the daily. It's crazy. Like day traders, I don't know how, I'm sure some people do well, but I don't know how you can do that over the long term. And for a number of reasons. One, you're just getting lucky. There's friction costs. There's taxes. I mean, those three alone, eventually that bullet in that revolver is it's gonna meet you. Now, a couple other things before I close this thing out for great takeaways. In investing, it is taboo, and in our industry, it's literally just not. It's illegal to guarantee returns, and you can't. And one of the things that I loved about Buffett is he said that he can't promise returns, which again, he literally can't. But what he could promise was that his return would be the same as yours because he has his entire net worth in Berkshire Hathaway. I don't know if it's literally 100% right now because he owns a home and I think he owns a plane and all that. But it's one of those things where every single dollar that he had, his money was where his mouth was. So for those of you that are looking to work with an investor or a planner, you should ask that question. What is your money? What does that portfolio look like? Like why are you invested the way that you are? Why are you invested the way that you are, but you're recommending that I'm doing something different, even if we both have the same time horizon? Like get really granular with whoever it is that you're talking to if you decide to hire someone to help you. But if you're going to, on the flip side, if you're going to start in a business where you're managing people's money and working for it, you need to have that alignment, because eventually you're going to have to look yourself in the mirror. This is another quote. In investing and allocating capital, activity does not correlate with achievement. Just because you're doing a lot of trading does not mean that you're going to be successful. Just because a company is priced at a point where you shouldn't add more of it doesn't mean you shouldn't sell it outright. This is one of my favorites. Fools give you reasons. Wise men never try. This is regarding people trying to explain what's going on in the market or the economy and trying to justify it. Now, I love this one because I'll ask, sometimes clients will even ask me, they're like, well, what's going, like, why is this happening within the market? I don't know. You don't need to know. You need to know what matters. And a lot of the questions that are asked when it comes to the economy and policy for the purpose of planning and investing doesn't matter. It doesn't matter. Look at what is most important to you. This is a good one. The line separating investment and speculation blurs when market participants have recently enjoyed triumphs. Nothing sedates rationality like large doses of effortless money. What does that sound like today? I can't go to anything specific due to compliance, but just think about which investments have done crazy well no matter what has been going on. Has the market done really well regardless of what's been going on? Is there some truth to that? Is there some validity to that in the long run? Sure. I mean, you could go through records and all of that. I mean, it's in my first book. But good times like that cannot last forever. So when they seemingly are lasting forever, who actually knows what they're doing? You're not going to know that until there's some type of downturn. And you can't guarantee, no one knows when a downturn is going to be. Nobody knows. But I'll tell you what, when a downturn does come, that's when you're going to figure out who knows what's up. And speculation is hands down the most dangerous when it looks like making money is easy. Here's another good piece of advice. Run your business as if it were the only asset your family will own for the next 100 years. In the world of merger and acquisitions today, which is crazy, think about how many people are running businesses just to sell them in 3 to 5 years. I'm not saying those are bad people, but you should have some familial continuity and that flavor of family when it comes to the business. I'm not saying everyone needs to have like a family-ran business, but I think in the long run, the odds of your success are going to be greater if you apply a lot of those principles. Oh, here's one. Excitement and expenses are investors' enemies. By no means is this a guarantee, but a lot of people ask me, they go, well, how can you tell if a stock is going to go up or down? Again, that's impossible in the short run. It's impossible in the short run. Technically, it's impossible in the long run. However, if certain numbers are screaming at you, like legit numbers, then eventually the stock price does catch up to that. And there's a couple terms, or there's a couple things. Stock prices move in rough tandem with earnings. So So profits. Market prices and the intrinsic value of market prices, which is, so a market price, that is what it is. So if you Google XYZ company stock price today, that's what the price is. The intrinsic value is what the company is actually worth. So, and those can be different. And that's where you get into valuation and all that fun stuff. But the prices in intrinsic value, they often follow different paths. Sometimes this happens for a long, long time. Eventually, though, those two paths will meet. I don't know when, I can't guarantee it, but eventually they will meet. You don't want to, you obviously want to invest in what you know, but when it comes to investors, and I don't know what it is about the investment community, but they try to box themselves into certain styles of investments, like in terms of, size of company or, where they are in the world, things of that nature. Again, you want to invest in what you know, but what I loved about what Buffett does is he says that he only has one style of investing, and it's smart. So invest in what you know, and if you know the companies that you're buying, and like you really know it, you are making smart, educated bets, and chances are you're probably going to do really, really well. Arguably, you could do better than some people in the investment world. In fact, I can almost guarantee that. Oh, this is one of my favorite quotes. Everyone else is doing it is a rationale that is always a bad one, especially if it's the main justification for a business decision. It is totally unacceptable when evaluating a moral division. Whenever someone offers that phrase as a rationale, in effect, they are saying they can't come up with a good reason themselves. If someone tells you that, tell them to try to use it with a reporter or judge and see how far it gets you then. How many times have you all heard everyone is doing it today? That should be a red flag to you in a major, major, major way. Never count on kindness of strangers in order to meet tomorrow's obligations. When given a choice, trade good night's rest over extra profits. So a lot of people try to earn and squeeze that extra dollar out of their returns. And in planning, I actually see this all the time. And again, depending on the dollar size, it gets a little convoluted. But let's just take conservative money today. The average 1 month government bond as of today, as of our recording in late October, is about 4.125%. If you go and open an online savings account, the highest interest rates out there are about 4%. In theory, you're going to earn more in the bonds, 0.125% more. There's a lot more work that is involved with that. And yes, as the dollars become larger and larger, you can make the argument that 0.125 can become greater and greater and greater and greater. However, there also comes a point where simplicity is probably going to be a lot more effective. And I can make an argument going back to some of my most successful clients. They wish that life was more simple, like when they first started gaining success in the world of finance. And it's no different for you when it comes to long-term investing. And that's what Buffett wanted to make crystal clear. I would much rather take a good night's sleep over an extra few percentage points. And that's a direct quote. Beware the investment activity that produces applause. The great moves are usually greeted by yawns. So many people are caught up in the next hot stock or the next hot or whatever it is. When real estate was hot, private equity, it doesn't matter. There's always going to be like the next hot thing. What you should do is you should actually ask some of the most successful people you know how they made their money. And I could almost guarantee you all of them are going to say something that will be extremely boring to you because it's going to take time. They did the same thing over and over and over, and they got really, really good at it. I mean, it's really cut and dry. But when you're investing within a portfolio, the best returns are often those that no one sees at that moment. A lot of people wish that their investments are going to do well. And his quote to that, wishing makes dreams come true only in fairy tales. It's poison in investing in business. This is topical right now because as of this recording in the news, you're talking about interest rates cutting. You're talking about the economy with AI. You're talking about geopolitical risks. There's a lot going on in the news right now. What the economy, interest rates, or the stock market index might do in the year immediately following a purchase means nothing to me. That's a direct quote from Warren. So for you, if you're going to buy something, you want to have, yes, not only a long-term time horizon. For him, it's at least 10 years or ideally forever. But if you're going to own something for 10 years or forever, why does it really matter what happens in the next months or year or two? It doesn't. It really, really doesn't. One of the best questions to ask if you are going to get into business or if you're going to invest in a business, could you create a better worldwide business? So if you own a company and you ask yourself, is there a company out there that can do it better? Well, then you should really pay attention to that company. But if there isn't, that could be an answer to you going, oh, I should keep going with it. If you're an entrepreneur out there and you're thinking about starting a company and you're thinking, okay, could I legitimately do this better? If you could, go for it. But if not, if you're thinking, man, this is going to be a tall tale, almost impossible, then don't, because the odds are pretty slim. One thing that a lot of people misunderstand when it comes to investing and entrepreneurship and just success in business in general is many people believe that these entrepreneurs and these CEOs, they've taken huge amounts of risks to get to where they are. Most of them actually take, and they do take risks. Like, don't get me wrong, it's very risky starting a business. I can speak from experience there, but it's calculated risk. It's a very articulate risk. And that's different than just blind risk where you're just running like a madman. The last quote I'm going to read is, mistakes fade away, winners can forever blossom. And I was reading through a lot of this too, because there was a lot that I could have read, but I would have taken like hours. These are just some of my most popular ones that like popped out to me. And so for you all, I want to wrap this episode up with a couple takeaways that I gained from doing this. And these are by no means, I'm going to read these in the order that I have, but these are by no means the order that I think you should, take away from them. Take them as you please. So the first one, if you are going to get into business of any kind, be as full disclosure as humanly possible. Not only will you sleep well at night, but someday when you have to answer to all of your doings, you will be glad you took that path of promise. Number two, it's one thing to understand an investment or two, regardless of what type of investment. So real estate, stock, whatever. It's a whole other ballgame when it comes to understanding how much you should allocate to each investment relative to the amount of risk you think you are taking to make this investment. This refers to what Monish Pabrai mentions in his book, The Dondo Investor, as the Kelly formula. And this is something I've actually been spending a ton of time researching at the moment. I may come out with an episode on the Kelly formula later this year or next year, but that's to be determined. And the reason why I bring this up is Warren Buffett did not get to where he is today merely because he invested in the best companies. He is the living master of the Kelly formula. And I'm just going to say it right now. There will never, ever be another investor like Warren. And not only will there just never be another investor like Warren, because you have to start when you're 10 and do this for like 85 years and crush it. Like that's just unheard of. But you're not going to be able to master the Kelly formula relative to the asset allocation skills that he has. You just won't. But if you can learn from his actions and be a fraction as good as him, I don't care if you're in second place or third or 12th or whatever, you will be a multimillionaire. Number 3, if you are going to earn any loyalty in this world, first, you must learn to give it. 4, have a locked-in memory on your winners as they will forever blossom. Don't completely forget your mistakes, but when you have them, which you will, figure them out and be rid of them fast. 5, wealth creation is not in the doing, it is in the waiting. Patience is the most prudent course of action when it comes to investing. 6, envision yourself holding investments forever, but don't commit to forever. 7, be extremely wary of effortless money. And this one I already knew, but you really, really, really need to hammer this one for those of you listening at home, because if you don't, it will eat you alive. It will eat you alive. And I've seen it in my career, and I don't want it to happen to you. And 8, and the last one, alignment, alignment, alignment. It's the whole concept of treat others how you'd like to be treated, or reverse it. And if you are being sold what you are selling, would you buy it? Like I will tell you, I take personal pride in how aligned I am with my clients. In literally almost every single way that I can be. Yes, there are exceptions. I'm not 70 years old. I'm 34. So there are certain strategies that I wouldn't use due to my age. And yes, there are certain investments that I own that certain clients don't own, because new clients coming in to our practice, those investments might be close new investors, things of that nature. But as aligned as I can be relative to, what I have at my fingertips today, I sleep like a baby. And this is not becoming a, oh, look at me episode, because really this is what I got out of Buffett's annual shareholder letters. But I hope you can take that little nugget from me in whatever it is that you're deciding to do. Because the more aligned you are with everything that you're doing in your life, the better off you're going to be, not only here, but when you're gone. So that does it for today's episode. I had a blast doing this. For those of you that are thinking about reading every shareholder letter that Warren Buffett has written, I encourage you to do so. I do not encourage you to do what I did and just absolutely sacrifice your life. I mean, I got through these in about, and this is about 1,000 pages. I got through this in about 2 months, 2 to 3 months. And that was on top of just everything else. And so my amazing wife did not appreciate me reading these during the long evenings, and probably lost a lot of sleep doing so. But I do recommend that you do so. And what I would ask for you is, when you do get through all of these, shoot me a DM, shoot me an email. Let me know what you think. And if you want me to continue to expand and elaborate on what I learned from these shareholder letters, let me know, because I would do so in a heartbeat. So That does it for today's episode. As always, I'm your host, Christopher Panayiotou, certified financial planning professional, the Cap and Capitalize. And until next time, keep capitalizing. Take care. As always, thank you for joining me today. If you have questions about today's episode or any personal finance questions, please reach out to me at Cap and Capitalize on Instagram, Chris at capitalizeyourfinances.com, or via our website, capitalizepodcast.com. If you want more Capitalize Your Finances content, head on over to capitalizepodcast.com and check out our blog, free resources, book, and online course. As always, I'm your host, Christopher Panayiotou, certified financial planning professional, the Cap and Capitalize. And until next time, keep capitalizing.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. The information in these materials may change at any time and without notice, and its accuracy cannot be guaranteed. There is no guarantee that any investment strategy will meet its stated objective. All investments involve risk, including potential loss of principal. All performance referenced is historical and is no guarantee of future results. There is no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification does not protect against market risk. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed and subject to potential federal and state law amendments. There's no guarantee that you will achieve the results discussed or illustrated. Index funds do not protect you from market ups and downs. Some index funds may have concentrated holdings. Index funds do not shield you from business or governance risks in prolonged downtrends. Index funds can perform poorly. Indexes are set portfolios, limiting flexibility. Before investing, carefully consider an index fund's risk, investment objectives, charges, and expenses. To obtain a prospectus or summary prospectus which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. All indices are unmanaged and may not be invested into directly. An asset allocation strategy does not ensure a profit or protect against loss. Bonds are subject to market and interest rate risk if sold prior to maturity. Bond values will decline as interest rates rise. Bonds are subject to availability, change in price, call features, and credit risk. Bond yields are subject to change. Certain call or special redemption features may exist which could impact yield. Investments in real estate may be subject to a higher degree of market risk because of concentration in a specific industry, sector, or geographical sector. Other risks can include but are not limited to declines in the value of real estate, potential illiquidity, risk related to general and economic conditions, stage of development, and defaults by borrower. The information contained herein does not constitute an offer to sell or a solicitation of an offer to buy securities. Investment products described herein may not be offered for sale in any state or jurisdiction in which such an offer, solicitation, or sale would be unlawful or prohibited by the specific offering documentation. Christopher Panayiotou is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. Capitalize Your Finances LLC is a separate entity from LPL Financial. Capitalize Your Finances is not registered as a broker-dealer or investment advisor. CRPS conferred by College for Financial Planning.